Hello, and welcome to this session. My name is Leroy Meadows, and we'll go ahead and be discussing today the master budget and responsibility accounting. So what are we going to do in this chapter? Well, first of all, we're going to describe the master budget and explain some of the benefits of the master budget. We're going to describe the advantages of budgets, prepare an operating budget and a supporting schedules. We're also going to use computer-based financial planning models for sensitivity analysis. Then at that point, we'll switch over and start our focus on responsibility centers and responsibility accounting. We'll recognize the human aspects of budgeting and then also appreciate the special challenges of budgeting in multinational companies. So let's go ahead and get started. Now, a budget is the quantitative expression of a proposed plan of action by management for a specified time. And we're going to see a little bit more about that proposed plan and that specified time. And a budget is also an aid in coordinating what needs to be done to implement that plan. Now, budget generally includes a plan's both financial and non-financial aspects, and it kind of serves as a roadmap for a company to follow in upcoming periods. So it's given us a guideline here that we want to do, what we want to do in the next period, whether that period is a quarter, a month, a year. So now, what do budgets help managers do? Well, they help communicate directions and goals to different parts of the company to help them coordinate the actions they must pursue to satisfy customers and succeed in the marketplace. So, in other words, we have goals of the different departments, and these we communicate these directions to the different departments because every department is going to be different in how it needs to meet the goals that are assigned for that department. For example, production. There might be a goal to reduce waste or a goal to reduce costs. Well, in that case, the goals for that part of the value chain may be different than, let's say, marketing, where we want to get a higher return on investment with our marketing dollars. So each department is going to have, each part of the value chain, each department, each division is going to have a different set of goals. And by the company's top brass, the top leaders, coming up with a big master budget is going to help them allocate to each department what they need to do in order to help the company as a whole make its budget. And also, it's going to judge performance by measuring financial results against planned objectives, activities, and timelines so we can learn about any potential problems. And then also, it motivates employees to achieve their goals. So when we talk about, and let's go back to judging performance here. If we have nothing if we have nothing objective, like the master budget, it's going to be set in stone. We are expecting this amount of sales revenue, this amount of costs, this amount of gross margin, and this and X amount of general administrative expenses. Well, if we don't have an objective, how can we measure to see how well or how unwell, how poorly we've done, if we don't have anything objective by it? So we're always going to take our objective, take our budget, and compare our actual results to our budgeted results to see where did we shine, where did we do well, where did we miss the boat, and maybe we need some improvement. And then also it helps to motivate managers. And why? Because a lot of employees will feel like if they don't meet their budget, if they don't meet what they need to meet, then they failed the company, they didn't measure up. So that's the kind of thing that a budget will do to motivate employees, as long as it's a challenging budget and not too difficult, so that everybody gives up, or it's too easy and everyone will lose interest. As long as it's a challenging budget to keep us motivated, and to keep everybody motivated actually throughout the budgeting period, we're going to do everything we can to make the budget. So now, Budgeting is most useful when it's integrated with a company's strategy. Remember, we talked about in chapter 1 where strategy specifies how an organization matches its capabilities with the opportunities in the marketplace to accomplish its objectives. Now, what is the objective of every company? To earn a profit of some sort. Now, is that the only objective? Well, you have some companies that want to turn a profit, but at the same time want to have other goals like sustainability or lessening the impact on the planet. So, whatever our objectives are, strategy is going to tell us how we are going to take our capabilities, what are we good at, what are we able to do, and then look in the marketplace and find opportunities there. So now, when we're developing strategies, there's a number of questions we have to ask. First of all, we have to ask ourselves, what are our objectives? If we do not know our objectives, we do not know where we're going. It's kind of like going. Think of it this way: if I take a little sailboat and I just launch off Miami, and I just let the wind carry me wherever I go, and I'm just like, yeah, wherever, it's no big deal. Is that very smart? No. So we need to know where we're going, because if we don't know where we're going, then we don't know if we're getting there or not. Second of all, how do we create value for our customers while distinguishing ourselves from our competitors? We want to provide value for our customers, but we also want to separate ourselves from our competitors. We also want to distinguish ourselves. We want to have something different than what our competitors have. We always want to have a little bit better product. And then also, how can we create value for our customers and our clients? What are our markets? Are the markets for our products local? Let's say local to Lorain County, or maybe regional, let's say the Midwest, or is it national to the whole United States? Or do we have a global market where we can sell our products here in Canada, maybe in Europe, maybe in South America? What are the markets for our products? Then we have to ask what kind of trends affect our products. If we don't know what trends affect our products, such as, let's say, do we have our markets pretty much seasonal? Do they do well in good times and do poorly in bad times? Or do we have a product that can do well in either time? What is a good example of a product that sells well both in good times and bad times? Well, basic toilet paper. You need toilet paper whether the market's good or the market's bad. Whether the economy is good or the economy is bad. You need toilet paper. Enough said. Now, the next question we have to ask is how do the economy, our industry, and our competitors affect us? See, we cannot just feel like we operate in a vacuum. We don't. We have outside forces that affect us, such as the economy. Is the economy roaring? What about our industry? Is our industry taking off, or are we getting left behind? Or how do our competitors? Maybe we're doing well. Maybe our industry is doing well. The economy is doing well, but maybe our competitors are eating our lunch, or maybe they're not affecting us, and we're doing well along with the industry and with the economy. How do our competitors affect us? So how do all those three things affect us? What type of organizational financial structure serves us best? How do we organize ourselves as a company, and how do we capitalize ourselves as a company? In which way serves us best? And what are the risks and opportunities of alternative strategies? And what are our contingency plans if our preferred plans fail? So, in other words, if our main plan, our main goal, our laid out strategy doesn't work out the way we thought it would, do we have a backup plan? If plan A fails, do we have a plan B or plan C? So what are the risks or opportunities of alternative strategies. So we should have not just one plan, but we should have multiple plans in case our main one fails. Now, before the the budgeting cycle is before the beginning of the year. Managers at all levels will take into account past performance, market feedback, the feedback we get from customers and from people who have influence, and then we're going to anticipate any type of future changes to initiate plans for the next period. And then senior managers will give subordinate managers a frame of reference or a set of specific financial or non-financial expectations against which they will compare actual results. So we see that judging of performance here. We're going to tell this department, hey, you've got to cut costs by 18%, or you need to reduce waste, or you need to dramatically reduce overtime, idle time. What can we do to keep the machines running longer so we can be more productive? Things like that. So it's financial, non-financial. Managers and management accountants investigate any deviations from the plan. We'll learn in chapters 7 and 8 when we're doing variance analysis about management by exception, where we focus on areas of the company that are not doing as well, and not have as much oversight on areas that are doing well, because they don't need that constant oversight, but we need to pay more attention. Not that we're forgetting about the good parts of the company, but we want to make sure we pay enough attention to the weaker parts of the company. So the master budget is really a working document, and it's at the core of the budgeting process. And it kind of expresses management's operating financial plans for a specific period. Now, the operating decisions, and there's two types of decisions we're going to make here. Operating decisions deal with how to best use the limited resources of an organization. So we already have the resources. How do we best use those resources of an organization? Whereas the financial decisions deal with how to obtain the funds to acquire those resources. So operating, again, how do we best use the limited resources of an organization? And we're going to do that through the operating budget. And the financial decisions, or the capitalization decisions, will deal with how to obtain the funds to acquire those resources, and we'll do that through the financial budget. Now, what are some advantages of a budget? Well, integral part of management control. When budgets are thoughtfully administered by managers, budgets will do the following. And they will, 1, promote coordination and communication among subunits within the company, because people have got to work together. We're going to provide a framework for judging performance and facilitating learning. So we're not just being critical. In fact, we don't want to really be critical of people. We want to be critical of where we're weak at, so that we can learn where we went wrong and make adjustments for those in the future. And again, motivating managers and other employees. Now, the budgeting process is time consuming. It can take a lot of time, especially for smaller companies, bigger companies. It doesn't matter. If you're going to prepare a proper budget, it can take a lot of time. Senior managers take 10 to 20% of their time on budgeting, and finance departments, other departments could spend as much as 50% of their time on it. So for a lot of organizations, the annual budget process is months long exercise, multiple months, that consumes a tremendous amount of resources. Now, when we're talking about budgets, we typically think of a budget for a year. And that is usually the most frequent and budgeted period. But we can have budgets longer if our focus is on very long term, like the capital expenditures budget, when we're looking at capital assets that we're going to be purchasing. Business may also use a rolling budget, and that could be for weeks, maybe even 1 week, or maybe just for a couple weeks. Then we can also use a rolling budget, and the rolling budget is simply where After the period ends, we add the next month or the quarter or the year, whatever it is. So if I have a 6 month rolling budget, as this month falls off and this month comes to an end, well then I'll add another month to the end. So I'm always looking 6 months out. So in the book, we have an example for the Stylist Furniture. Now, that's a company that makes two types of granite top coffee tables, the casual and the deluxe model. And the CEO is concerned because the board wants 10% increase in profits in the next year. So what is the CEO going to do? Let's go through the 5-step decision-making process. The first step is to identify the problems and uncertainties. And in the book, with stylistic furniture, we have to find a way to build and achieve a 10% profit growth. There's a lot of uncertainties. Can we dramatically increase the sales of its most profitable deluxe tables? Are there any price pressures to face? Will the cost of materials increase? Can we reduce costs through efficiency improvements, reducing waste or rework or scrap? Then we want to obtain information. So we're going to get information about the sales of the tables for the current year. What about our competitors? Are our competitors still nipping on our heels, or are they falling by the wayside? And are we gaining market share? If we're gaining market share, then that makes that 10% growth a little more likely. Did our cost of materials go up? That was one of the questions we had in step one, identifying the problem and identifying any uncertainties with that. And then let's say in obtaining information, we find out that, hey, maybe cost of materials did go up a little bit. So in step three now, we're going to make predictions about the future. So we're going to make, based on our best information that we got after obtaining information, we're going to make some decisions. We've taken into account market forces, competition, economic forces, and we're going to make predictions about how to, and make a choice, as far as not just the two tables. We may be increasing sales about the table that provides the lesser amount of profit between the two, or the one that, or the strategy may be to increase the more profitable one of the sales of the more profitable ones. We don't know until we gain all the information and we can make predictions. And then once we've figured out between the different alternative ways of meeting that 10% growth, then we can choose the plan that we think is going to help us be best in achieving that 10% growth. And then once we choose that plan, we're actually going to implement that plan, and not just at the end, but throughout the period, evaluate performance, learn, and it's especially important as we go along, not just to wait to the end of the budgeting period to evaluate and learn. We want to watch ourselves as we're going through the year. Why? Because we may be doing great, and we could maybe gain in one department or one division or with one product might help to offset some weaknesses of another product that is not selling as well. So we can use that and maybe tweak it up, maybe increase our sales price just a little bit, or instead of raising our sales price to the customers, maybe we reduce the amount of discounts, the amount of sales, things like that, because we don't need them, because those strong sales are going to bring customers in anyway to our stores. So we want to be able to tweak our stuff, tweak our actions as we go along, and then learn from them. Learn as we're making, as we keep checking ourselves, we can always check and say, hey, oops, I missed it. Let's tweak this, and we're good. So now there's two types of budgets: the operating budget we just talked about a couple slides ago, and the financial budget. Remember, the operating budget is dealing with how best to use the resources we have, And the financial budget is going to look at how do we raise the money to acquire those resources. So the operating budget is going to begin with the revenues budget because that's the cornerstone of the budget. Without that, we don't have anything else. We cannot schedule production. We cannot schedule materials, the cost of labor. We cannot figure out any other costs associated with making the products. Our period costs. We cannot calculate income. So we need that revenues budget. That's the cornerstone. Then the financial budget is made up of a number of different budgets: the capital expenditures budget, the cash budget, the budgeted balance sheet, and the budgeted statement of cash flows. So in the basic operating budget, we're going to prepare the revenue budget first. That's the starting point. If we don't prepare the revenues budget, then we don't know as far as how many units we expect to sell, plus what is our selling price. So the revenues budget is just basically taking the number of units we're selling times our sales price, our budgeted sales price. That will give us our revenues. Now, based on the number of units we expect to sell, we're going to prepare a production budget. And that production budget is going to tell us how many units do we need to produce. Now, most companies want to have some extra inventory in finished goods or in work in process or what have you, but we want to have some extra inventory so that if we get an increase of sales, then we have those extra units to sell. So the production budget will almost never equal so units produced will never equal the units sold. Why? Because we're going to have beginning inventory to concern ourselves about, and then we're going to have to figure out what is our desired level of ending inventory. So between both of those, the number of units we produce would not equal the number of units sold. However, that will give us the number of units that we need to produce. Then, based on the production budget, I can now figure out how much indirect materials I'm going to use, and then the purchases required for those direct materials. Then, after I've computed my direct materials usage budget and how much it's going to cost me, then I'm going to prepare a direct manufacturing labor cost budget. Once I've computed my direct manufacturing labor cost budget, I can then do my manufacturing overhead cost budget, figuring out how much in property tax are we going to have in the facility or on the offices, how much rent is it going to cost me, what do we expect to pay in utilities, a number of different things. What about insurance? How much is our insurance going to be in the facility or on our inventory as we're producing them? So I've got a lot of overhead costs that I need to account for, and I need to plan out ahead. Some of those are going to be fixed, some of those are going to be variable, but we should have a good sense of what our manufacturing overhead costs are going to be. Then we need to prepare our ending inventories budget, not only in units, but in dollars as well. Then we're going to prepare the cost of goods sold budget, and then the revenues minus our cost of goods sold budget will give us our anticipated gross profit. And then from there, we'll prepare the non-manufacturing cost budget, or the selling and administrative cost budget. And from there, I can get my budgeted income statement. So there's a lot of things we're going to do with the operating budget. That'll start with the revenues budget and get us all the way down to the budgeted income statement, where it's going to show how profitable are we going to be. Now, based on the operating budget, in fact, there's a number of things that on the operating budget is going to help me prepare to give me answers on the budgeted balance sheet, such as the level of inventory I expect to have. But I'm also going to need to prepare the capital expenditures budget. Why? Because I need to, because we're going to invest in a new plant facility. What about new long-term assets, new machinery? Those are something we don't typically buy on a normal, on a regular basis. So we make those plans out long ahead of time. So we're going to prepare the capital expenditures budget. We'll prepare the cash budget. And with the cash budget, we're going to just simply take all of our revenue, all the money, the cash that we're going to get. And the cash budget is basically timing our cash flows, when cash flows are coming in and when cash flows are going out. Now, why is that important? Well, we're not going to see just one big lump of money come in at the beginning of the year, but cash rolls in at different times of the year. And let's say some of our biggest bills, maybe say property taxes on the plant, come in every 6 months, and in one 6 month period, is a pretty big bill, and it comes in where our sales are their lowest. Well, I need to budget how much cash inflow I have versus cash outflow, so that I can utilize short-term borrowing and take advantage of that, so I can prepare for that ahead of time. And then finally, the budgeted statement of cash flows. So here's just an overview of the master budget, where we just illustrated the operating budget is simply from the revenues budget all the way down to the budgeted income statement. And then the financial budget is the capital expenditures budget, the cash budget, and the budgeted income statement is going to all that's going to go into the budgeted balance sheet. In fact, with the cash budget, we'll be able to figure out our beginning and ending our ending accounts receivable, where we expect to be at the end of next year with our accounts receivable in the balance sheet, accounts payable, so we can anticipate, we can create our budgeted balance sheet through our cash budgets, and then also through the different budgets here in the operating income. And then once we get our budgeted balance sheet, then we can do our budgeted statement of cash flows that takes everything into account. So now, with financial models, these are simply mathematical representations. Financial planning models are mathematical representations of relationships among operating activities, financing activities, and other factors that affect the master budget. And so what is sensitivity analysis? It's a what-if technique that examines how a result will change if the original predicted data are not achieved, or what if there's a change in the underlying assumption. We can make the best, we can have the best laid plans, but let's say that something happens and gas shoots up. What is that going to do to the cost of running our fleet of vehicles? What if utilities go up? What if sales go down? What if we adjust the sales price? There's a number of things that can happen, so that we can take those assumptions into account. If we can take those changes into account if there's a change in the underlying assumption. So sensitivity analysis is used by managers in planning and in budgeting. So let's look at stylistic furniture. We talked about them already, and they were using the illustration earlier in the book about the 5-step decision-making process. Now, here are 3 key assumptions that stylistic furniture has. We have the units sold here, we have the selling price, and then the direct materials cost. We have the master budget scenario. We're going to sell 50,000 casual granite coffee tables, granite top coffee tables, 10,000 deluxe granite top deluxe coffee tables. We've got their sales price, $600 for the casual, $800 for the deluxe, $7 of direct material costs for the red oak, $10 for the granite. And so we've got an operated budgeting income. But let's make some tweaks to 2 key assumptions. Let's say that we have to lower our sales price. So scenario 1 is where we have to lower our sales price. Then what happens to our operating income? Do we make that 10% growth? No, we don't. We actually have a 22% decrease. In scenario 2, my sales price remains the same, but the cost of direct materials goes up. So how does that impact my operating income? And as you see here, I have an 8% decrease from my budgeted amount. So this is an example of a what if scenario where we can change things and apply the principles we learned in cost, volume, profit analysis. We can carry those over into the budgeting process to help us make decisions if something changes. So now let's talk about budgeting and responsibility accounting. How each company structures its organization significantly shapes how it coordinates its actions. What is our company structure going to be like? Functional organizations develop strong competencies within each function, but are generally less focused on particular markets or customers. So we're looking at things as a whole, as a function, but not necessarily on the individual customer or individual markets. And so firms that are organized by product line or brand are more focused on the particular markets or customers. So it depends on where our focus is, how we structure ourselves. So now each accounting manager, regardless of level, is in charge of a responsibility center. A responsibility center is part of a segment, some subunit of an organization whose managers are accountable for a specific set of activities. Now, responsibility accounting system is a system that measures the plans, budgets, actions, and actual results of each responsibility center. So we're taking our budgeted plans, taking our actual results, and comparing the two. Now, there are 4 types of responsibility centers. A cost center is where the manager is only accountable for controlling costs. Think of a production manager. The production manager does not order materials, so they're not, but they do what? Control labor costs. So think of a production manager as being responsible for costs, and they're only accountable for costs. Are they accountable for generating sales? No, because that's the marketing department. Now, a revenue responsibility center, an example of that would be the marketing department because they're accountable for revenues only. They have no say in the controlling of the costs. They are only responsible for generating revenue. What about a profit center? A profit center could be accountable for it will be accountable for revenues and costs. So what's an example of that? Well, think of a local grocery store. They have to generate revenues, but they also have to manage the cost, not only of the labor, but of the overhead and also the cost of the products they're going to sell on their grocery shelves. So that's an example of a profit center. An investment center is accountable for investments, revenues, and costs. So it's more of the reinvesting into the company, the profits that we have, and how are we going to reinvest them into the company. Maybe we're going to upgrade our certain key locations with a new point of sale system. So we can get more accurate data. The clerks can move faster, things like that. So now budgets will give us, with the responsibility accounting, we can provide feedback to top managers about their performance relative to the budget or due to their responsibility center managers. So how do budgets offer feedback? Well, they're going to give us variances. Our actual results are going to deviate from our budgeted results. Why? Because we don't have a crystal ball and we don't know exactly how much we're going to sell. So we're going to have some variations between what we budgeted and what actually happens. So we're going to have variances, and those variances we'll look at in chapters 7 and 8 with direct costs, variable overhead, and fixed overhead. But what do variances provide managers with? Well, they give us early warning of problems, especially if we're watching as things go along. They're going to give us a basis for performance evaluation. How well did you keep within, let's say they have a margin of error of, or an acceptable range of being off by like maybe 1.5%. Were we off 2.5%? Okay, then we didn't make it. Then our performance is going to reflect that we missed the mark. But let's say instead of being off by 1.5%, we were only off by 0.5%. Well, then we were within that margin that we were allowed, that was being allowed for us. So we, in essence, made our target. And this is going to give us a basis for strategy evaluation. Evaluating your strategy, do we need to tweak it? Do we need to restate it? Do we really need to rethink things? Do we need to change our focus? Now, responsibility and controllability. Controllability is the degree of influence a specific manager has over costs, revenues, or related items for which he or she is responsible. And of course, a controllable cost is going to be any cost subject to influence of a given responsibility center management for a period. So when we talk about controllability, if a manager has no control or no degree of influence over specific things, then we should not be holding them responsible for things they have no control over. However, to the greater degree of influence we want to that a manager has over certain costs and revenues, well, we want to hold them responsible for it, to make sure that what they are doing is helping the company meet its goals. So, and again, in controllable costs, any cost primarily is subject to the influence of a given responsibility center manager for that given period. So responsibility accounting, what does it do? It helps us to first focus on whom we should ask the information and not whom we should blame. We don't want to blame someone. That's not our focus. At some point, we may have to deal with things if things are not progressing as planned, and this has been an ongoing situation. But generally, responsibility accounting is not saying who do we blame, but who do we ask to get information, because there may be a very legitimate reason why. Some of the higher ups may not realize the impact of an increased cost of direct materials or direct labor when they negotiated a labor contract with the union that's running one of our production facilities. There are so many variables involved in costs with different costs that we just need to know who to ask, because that person that we ask, if we're asking the right person, will give us the information that we need to evaluate and then learn from it and then make future adjustments. So responsibility accounting is focusing on gaining information and knowledge, not only on controlling situations. So what is the purpose of it? Is so we can enable future improvement. And then so each responsibility center is going to have its own performance reports, and they're going to be tailor-made to each department, each responsibility center. Let's see. They're sometimes designed to change managers' behavior, even if the reports decrease controllability. So now there are some things about the human aspect of budgeting, because after all, we are humans and we are the ones that are actually doing the budgeting. So we have to emphasize that the human factors are crucial in budgeting also. Because see, too many times we thought of it as just a numbers game and that's it. And they're free of emotion. But they're not. There are emotions involved sometimes. We have to try to separate those emotions. However, they're not just automatically free of emotion. And we think of it that way. We think of just the cold, hard numbers, but that's not necessarily the case. But the administration of the budget requires education, persuasion, and intelligent interpretation of the numbers. So now and let's talk about some more human aspects of budgeting. Budgetary slack. This can happen in any organization. And what budgetary slack is underestimating budgeted revenues or overestimating budgeted costs so that the targets are easier to achieve. Why? Well, to look good. It could be that our bonus depends on how much we do over budget, or as far as revenues, or under budget with regards to costs. And if our revenues and if our bonus changes and increases the farther away we get from our budget, then that could be an influence as well. Now, what we'd like to do is actually introduce stretch targets. These are challenging but achievable levels of expected performance. And yes, they're going to cause some discomfort. They're going to cause a little bit of pain, but these are challenging. We want to make sure it's not too challenging, because then people will give up, or too easy, like in budgetary slack. We want to find ground in the middle, somewhere where it's challenging, but we can achieve it. We just have to work really, really hard to do it. And then there's another concept in budgeting where we're talking about Kaizen budgeting. And this is a concept of incorporating continuous improvement during the budgeting period and in the budgeting numbers. For example, let's say that our goal is to decrease our cost of goods sold by 1/2 of 1% each and every quarter. So or each and every month, whatever. So for each and every quarter, I want to see my cost of goods sold come down by 1/2 of 1%. So if I expect it to be, let's say my cost of goods sold this quarter is going to be $100. I expect my cost of goods sold, if I'm going to sell the same amount of units in the next quarter, to be $99.50. So we're continually improving, we're pushing for continuous improvement. Back in chapter 1, you read where we talked about total quality management, continuing improvement to provide and delight customers. Well, with Kaizen budgeting, we're actually taking that continuous improvement concept and not just incorporating that into how we treat customers and how we evaluate processes, but we're now incorporating that into the budgeting process. Now, one last thing we want to think about is budgeting in multinational companies. And we're going to have some issues in that. Why? Because there's new markets, new resources, so there's a lot of good opportunity there, especially if when we identified our own markets as maybe national, but we want to make ourselves international and have international markets. We want to become a global company. Well, if that's the case, then an international presence has a lot of benefits, new markets, resources, but also has drawbacks, operating in less familiar business environments, currency fluctuations. And when you get into advanced accounting, you'll talk about that exchange rate, the change in exchange rates, interest rates may differ. You're going to have a lot of different economic values when exchanging and going back between a euro denominated continent versus the dollar denominated United States. So you're going to have a lot of different things here. And plus, can earn revenues and incur expenses in many different currencies. And then you're going to have to translate all those into a single currency for reporting results to shareholders each quarter. So you're going to have to actually take, that loss of, let's say, 500,000 pesos. You have to translate that into dollars at the end of the period and show the American, we're assuming the domestic company here, showing your American investors in dollar terms. So you're going to have to translate all those. What if we have to do the yen, and then we have some francs, and then we have some euros, and then we have some pesos? If we're in a lot of different markets, that's a lot of different translating, especially when exchange rates can fluctuate based on the strength or weakness of the dollar in relation to such. So you're going to have a lot of different, issues with that. Those are probably some of the biggest things you have, especially with budgeting. You're going to have to predict all those extra changes, and a lot of those changes are going to be outside your control. So that is the end of this session where we're talking about the master budget and responsibility accounting. Thank you for joining me. Have a good day.